Hi, this is Steve O'Hare from Pia First. Welcome to our webinar on medium-term outlook in both equities and commodities. We're going to run through a number of products. I'd like this to be a interactive webinar, so feel free to ask questions or interject and ask me about different markets if you want. I'll run through what I was going to go through today was the major equity indices and then the major commodity markets in focus at the moment. But I can take a look at others. So I'm going to give you a medium-term trade idea, which is what we produce at PIA First. Our main flagship product is the Predictive daily analysis and trade ideas. We produce this as a group. My business partner in Coleman has over 25 years experience in the markets. I myself have over the 25 years as well, from a trading, broking and analytic perspective. So I'll jump straight in, go straight into the DAX market, the European, the German product. Let me just shoot across to that one. And you should all see a chart of DAX. So the daily chart in DAX. And basically what we do in technical analysis, we look at different time frames to produce a trade idea. So if we're looking for a medium-term trade idea, we start by looking at the long-term chart. That'll be the weekly chart. And this is a line chart of the DAX going back to 2011. As you can see, from 2011, there was a major uptrend to mid or early 2015, when we suffered a correction last year. And this correction has continued this year. Now, the reason I've brought a line chart up is that these are the best charts to look at from a long-term perspective. They feature the closing price on a weekly basis, and they take out a lot of the noise of the daily charts. And they give some very good trend lines, because the closing price is one of the key numbers we look at on any given basis, a weekly, daily chart, hourly chart. The closing price is very key. So we can see that earlier in the year, we broke, over Christmas time basically, we broke the upward trending support line that has been formed by 1, 2, 3 dips. And this pattern that we look at looks very much like a very well-known pattern called a head and shoulders formation. This is a reversal indicator, and we expect prices to reverse when a neckline is broken. A neckline would be the low point between a shoulder, which is this peak here. This would be the start of the neckline. This would be the head. This would be the bottom of the neckline. This would be the right shoulder. So a break and a close below this neckline indicates that we're due a further correction downwards. So this break in the upward trend has switched our medium-term bias to bearish, although we have been bearish after prices broke this double bottom here, and we've been looking for a major correction since then. So that was into sort of like second, third quarter of 2015. We've been very bearish of equity indices across the globe. So let's drill down to the daily chart, and this obviously replicates what we've just looked at, but gives us more of we introduce candlestick charts to give us more of an idea of other formations or other indicators that are firing as we move along on a daily basis. And again, you can actually see a a similar type of pattern that we just talked about, the head and shoulders pattern. This is not quite as strong as the previous pattern because the longer term the pattern is, and the more of an uptrend there is before a head and shoulders pattern, then the stronger that pattern is. So again, there was a small uptrend here with a left shoulder neckline from here. This was more of a downward trending one. Head, neckline, shoulder, and prices have come off. So it's a bit of an awkward looking pattern on this daily chart. But nevertheless, it's proven to be pretty bearish on this trend line break here in January. So we look more on the, when we're given a medium term view, we look at medium term as anywhere between 1 day to 1 month. You know, we're sort of, when we look at daily charts on a daily basis, we talk about a trade idea during that European session or during that American session, during that day. When we look at medium term, it's just longer term than that intraday period. So this break of the trend line here was negative. Prices dipped lower, came back, found resistance and selling just below the 10,000 level. And further selling pressure has seen this move to 8,687. We formed, on the candle chart, we formed a bullish hammer here, which was then bullish engulfing following the bullish hammer, which was a clear reversal. And then we've had a big gap open over the weekend where equities have found buying interest and found a lot more to be happy about over the weekend. And this reaction higher has left a gap on the daily chart, which we would expect to fill, but you know, there's no exact timing on when that will fill. It doesn't look like it's going to fill today, which means that this this breakaway gap is quite a serious one, and we should get a decent retracement out of it. So now we've got to think about how much we will retrace. We'll keep the time frames into the last quarter, and we'll apply Fibonacci retracement levels on this. Generally, a retracement could be anywhere between 38% and 61%, even as far as 78% for a decent retracement. Now, let me just show you where I would start to build the trend line resistance, the horizontal resistance. I'll strip all these away. I'll start with my fib. And the first real line in the sand, as it were, or target for this correction would be around about this area here, coinciding with the 38% retracement. So we've still got a little way to go. We've still got this could turn into a nice little correction, and it would only be a mild correction. Our medium-term bias and long-term bias would remain negative. We would be looking at the DAX now and looking to sell into the rally and looking for good risk-reward areas. The risk of any trade, if we consider the risk of a trade is 1 point, £1, 100 points, we would look for a reward equating to up to double that, at least double that maybe, if not more. So, you know, even considering there are some good sort of medium-term trades that we see that sometimes equate to 5, 6 to 1. So let me just get a little trend line going here as well. Trend line requires at least 3 points to be a trend line. We've got the start here of the initial correction. We've got the rally back and the selling here, covering 2 candles, and resistance coming in on a daily basis would be equating to around 9,900. But obviously this will take time to develop this correction. So we'd be looking for it to coincide with the horizontal resistance that we've got around this 9,600 to 9,800 area. So that we expect congestion there. And that will be the first real test of this corrective wave. So very positive start to this week. On a daily basis, we're looking to buy into dips, but medium term basis, we're looking to sell into the rally. Now, ideally, what you would do is wait for the price to get to these areas, and then look for a sign of reversal or a sign of a stall in the trend. There's plenty of indicators we use. We use as well as using the Ichimoku cloud. Apply that to give you an idea. Again, that sort of is a great visual tool to show you where the longer term resistance is. You can also use moving average, which basically will show you how the momentum of the trade is working. You're seeing a crossover down here and momentum is turning positive. So that indicates there's plenty of room for a correction without impacting on the downward trending move. So we would be looking to sell around about this level, 9,700 to 9,800. Our long-term charts are showing we would only really address or readdress this view on a break of 10,000. I've been noting that level for quite some time now. I expect the retracement not to move too much above here, but again, we'd look to be selling around this area once we get a daily correction on the candles charts. So, or just some indication that sellers are returning. So it's a case of waiting and seeing how this move develops before entering the trade. If we were to make a predictive call, we'd be looking to sell around the 9,700, 9,800 area. The stop on this trade would be above 10,000. So you're looking at about a 300-point stop on the trade. But you'd be targeting a move back down to these lows. So even 8,700, you know, that's well over 2 to 1, 3 to 1 risk reward. Take a little look at the FTSE now. On purpose, I don't prepare my charts beforehand, because then it sort of gives you a good idea of how I do come to my ideas and build my opinions. It's a little chart on the FTSE, and it shows the divergence between or the correlation between FTSE and DAX. Sometimes you get the DAX leading the FTSE, other times you get the FTSE leading the DAX. So it's good to just have a view on this and have a look at this and see which one's leading the other, because the components of each index are made up of different products. As you look at all the different major indexes across the world, you get the NASDAQ that is more technology based, the Dow obviously more industrial based, and obviously FTSE is more financial bank based, and obviously the banks have taken a big hit in this first quarter this year, and that's what's put that under pressure. So any bad news for banks, FTSE would probably lead the way, and good news the vice versa. So again, we look at the FTSE chart and we look at how that's performed over the sort of similar time period. And it was only 2009 when we were looking at 3,500 as a base in the FTSE. This was after the banking crisis. in which FTSE took a huge drop. From then, obviously, prices have moved higher, and again, it's only in recent times we're starting to see this pullback. So long term, we highlighted a couple of points a few weeks ago where we saw this bearish flag, and prices have broken from the bearish flag. And I'll show you how we come to our assumption on where we expect this to go. So the bearish flag is targeting a move to just above 5,000. But again, we look at last week's candle chart. We see a bullish hammer. This is a positive sign after the extreme sell-off down to about 5,500 last week. Buyers have come in, reaction higher, and over the weekend, obviously good news, and prices have opened up stronger this morning. So the potential for a reversal here, and we can see that the reversal should be limited to this downward trending resistance line. You see the Ichimoku cloud again as acting as resistance above, but we've got potential to get well above the 6,000 level and up to the previous closing level of 25th of Jan, 6124, and wouldn't be surprised to see the prices move back to there over the coming days. But again, on a medium-term basis, we wouldn't be looking to buy this on a medium-term basis. We'd be looking to sell into the rally. On a daily basis, again, we're looking to buy dips, and we're looking to target higher levels. But on a medium-term basis, we'll be looking to set shorts around 6,100, 6,125. Stop on this trade would probably be a break of 63.25. So we keep the numbers round and even. It's a little bit more of an idea of just how we get to our levels. To get to the exact levels, we use bespoke tools that we do keep to ourselves to give ourselves a little bit of an edge to make our analysis a little bit more valuable. But they're all technical analysis or technical tools, technical indicators that we use. It's a combination of what works for us. So we would be looking to sell it around this level again at a 200-point stop, but we'd be looking to areas around about the 5,500, 5,400 level to take profit. So you're looking at a 200 tick stop against a 600, 700 tick profit. So a good 3.5 to 1 risk-reward ratio. Again, it would be better to leave this and to wait for confirmation of a reversal. This is the daily cloud. Again, the daily cloud will be showing resistance around these levels and should cap the upward move. You can see the bullish hammer. The bullish day Friday, small gap on the chart on here. I think that'll be ignored now for a while, and moving up to this 6,100 area. So both DAX and FTSE we're looking to set shorts in. Let's take a look at the Dow. Dow, again, a very clear upward trending move, which spiked through this upward trend back in August last year. But then that candle, the weekly candle, finished as a bullish hammer. And then after that, post that day, we had a bit of sideways congestion before prices then posted another small bullish hammer and moved higher. We were capped by the top of the daily or the weekly Ichimoku cloud before prices reversed. So, and again, we're seeing a very similar formation here. A couple of things to watch out for. This can be classed as a triple bottom. We call it a double bottom. Let's switch to the monthly chart to see how. Yeah, I mean it's you've got this decent support area that prices seem to get to and not hang about for long, and you see these reversal candles appear very quickly. So this bullish hammer on the monthly chart, obviously we're only middle of February, but it looks quite supportive for the Dow and offers a good chance for a pullback higher. We jump down to the daily. We see quite clearly the reversal on Friday, which broke 5 consecutive negative days, broke that sequence of negative performance last week. And again, started off on the front foot this week. There's a gap in the chart between 15,970 to 16,016, so a 45 tick gap. But overnight price action has been very firm, very strong. President's Day today, so it's there's not going to be a lot going on over here. Markets closing early, some shut. But we can see it bodes well and highlights a clear reversal in this recent sell-off. So market will be looking to move back up to this 16,500 level and test this resistance once more. I'll show you a pattern here. The pattern I'm looking at is evening star formation, which is a bearish pattern. This led to the move lower. This not quite a bullish engulfing candle. Because obviously we had this spike lower and a low start to the Thursday. Friday's very positive candle, Monday positive, and so we do expect a decent retracement this week. Medium term bias is still bearish. We still would consider possibly forming a flag pennant formation with eyes on a move lower. But again, the US stocks seem to be holding on a little bit better than FTSE and the European counterparts. So our initial thoughts on this, again, from a medium-term perspective, we wouldn't consider really changing our negative view until prices broke above 16,500. Now, double bottom formation sticks out here. Let's get a more exact reading on that. The double bottom formation is basically when a price action has moved and formed a new low. Prices rallied from it and returned to that previous low or close to it, very close to it, and failed again. And some analysts would say this is a double bottom formation already. It's not. It's only a double bottom formation or a confirmed double bottom formation when prices have broken back above the peak in between the two bottoms. So once this prices close above the 16,500 level, or to be exact, 16,511. So once they close above that on a daily basis, then that would be a confirmed double bottom. And price action would then target, let's get this exact for you, target, a measured move target to 17,580. So you take the measurement from the high to the low of this neckline and extend it from a break of this high. So you're looking at 17,550 plus. And that also would coincide with the congestion area around here. And it wouldn't be far away from a 78% retracement, which again is a great Fibonacci retracement level. So that's the possibility of the Dow. But until that point of closing above the neckline, this resistance line on a daily basis, we would be bearish of this. We'd still be looking to sell into rallies up to 16,500 in front of there. The stop would be a clear break of 16,500. If you had to put a number on it, you'd say 16,600, give it at least 100 points. You'd be looking to get short in front of 16,500. So, you know, your initial levels, you'd have to wait until it approaches there, but you'd probably pick up levels maybe 100 ticks in front of. So you'd have a 200-point stop. But again, you're looking for a return to down to this neckline here that we just pointed out. So you're looking at, you know, a decent sort of 800-point down move again. But it would be, you know, it's a wait and see approach once more. Ideally, it would get up to this level. It would then have a daily negative daily candle, signaling a reversal, maybe a shooting star, a bearish engulfing, an evening star formation, and then we'd be happy to set shorts. We'd have a clear idea, much more clear idea of where the stop would be, just above where the high was made, or maybe just above this trend line, this horizontal trend line here, and then we'd be looking to target a further retracement. But again, it's a more of a wait and see approach. I'll move on to S&P now. What we've got on the S&P, we've got the S&P, we've got the Dow, and we've got the dollar. S&P is this black line. This is a sort of medium-term chart. Blue line is the Dow, 16,200, and the dollar. So it shows how these markets are reacting with the dollar. Some clear correlation with an improving dollar picture. Let's focus a bit more on the S&Ps. Again, formations and lines drawn from a few weeks ago. We were looking for a break of this level to be quite key. Once we got this bullish hammer, we expected a return or resistance to be around about this area. Prices failed, and I just mentioned an evening star formation, and lo and behold, we've got one here. This is an evening star formation, evening doji star. Some great names for all these formations. But we like to try and look for the big ones, the key ones. This is a signal of price action running into heavy resistance in front of 1950, and the following day, the extended bearish candle brings an end to that correction. So we're getting a little bit more of a similar move now, a little bit more of a correction, but again, there's no real sign that this is a real change of trend, but it's a clear reversal. So we expect, again, this pattern, this move higher to continue, and positive price action into this week. But we'd be looking for the 1950 area to give us a decent signal, and maybe to fade into that area. But there's nothing really that jumps out in the S&Ps. Let's take it back. Let's take it back a bit more of a longer term chart. I mean, the one thing that does stand out is this trend line here, almost like a neckline. You have like a long drawn out head, shoulder, and a shoulder here, neckline. Break of this neckline, it's penetrated the neckline on 2 occasions now, with this weekly chart showing a bullish hammer. That should indicate a decent pullback. This isn't a trend line, this is just 2 points joined together. We get stalled around about this area along this trend line, and a reversal candle, that will signify that, again, we'll be attacking this trend line. But again, very vague, not really a clear picture on the S&P. Daily basis, again, we'll be looking to buy on a daily basis, but looking to this resistance area around 1950 to hold at the moment, and looking for a price action to see how that develops around that level. That's the equities. Any other equity markets that anyone wants me to quickly take a look at, let me know. I'll now pop across to commodities. Obviously, oil is one of the major commodities that we've been talking about for a long while now, and we can see how the dollar CAD and oil, and how they antagonize each other and move against each other. And so we get dollar CAD, dollar strength equates to negative price action in oil. We can see price action at the moment trading at $30. This is WTI oil, light sweet crude, not Brent. Hi guys, sorry, I think I dropped out for a second. Let me take it straight back into there. I hope you weren't gone too long. I just noticed it just now, so hopefully everyone's still with me. Say hello if you're there. Right, I'll carry on with dollar CAD and the inverse correlation between dollar CAD and oil. And we're seeing price action dollar CAD just turned slightly this morning. We've seen a little bit of an uptick in oil itself as well this morning. So we keep an eye on that, because obviously they're correlated. It's good to see how markets are reacting, so you can get, it can maybe give you not just an indication. You see a technical setup in oil, then you might have missed the ideal place to get in, but then there might still be an opportunity in dollar CAD from a selling perspective. So here we've got the opposite of the evening star formation in oil. This is a morning star formation where you've got a bullish hammer here in between a bearish candle and a bullish candle, and that's a reversal formation. That's been confirmed with buying interest today. So we're looking to buy on a daily basis in oil. But our medium-term view, long-term view remains very negative. we still are looking for a move to $20-ish. This is this ABCD formation has reached its target around $26. A, B, C, A, B, C, D. Yeah, so we've got a lot of things going on in oil at the moment, and as we saw a few weeks ago in January, a very, very similar formation has formed. Let me get the highlight then. Both Morningstar formations, and you can see the reaction here. And that's telling me that the market has potential to react to around about $34, at which point our medium-term view will kick in, and we look to come in and fade this trade on a medium-term perspective. You can have looking to set shorts around $34 a barrel. Stop on that trade would be placed well above the previous high, so placed about $36, so $2 stop on that trade. But we'd be looking for it to return lower than the previous move. So we'd be looking for it to come back down here in this area. And again, that'd be a 3-4 to 1 risk-reward strategy, so a good risk-reward strategy. And as I say, our medium-term bearish feeling in the oil continues. Gold has been pretty hot over the last few days, and you can see from this chart the great move we've had over the last well, since December, basically. December, we got, I'll highlight what we picked up in December. We highlighted this double bottom formation. Obviously, it's not a double bottom formation until it closes above that. It closed above this line. You would have been getting along around about the closing day, about 93, 95. And your target would be 11.30. It hit the target a few weeks later, and it was a really decent call and decent move. Now we've seen this break higher where we've broken medium-term resistance around 11.92. I'll pop back to the weekly chart just to give you an idea of where we are on a weekly basis, because there's a great formation we've highlighted for a long while now. In fact, all of last year we mentioned it. It's this downward trending line. It's like an ending wedge formation. It looks bearish because it's sloping downwards, but it's actually a bullish formation. Now this is the formation kicks in when you have a break of the ending wedge, which was highlighted by this close on the weekly chart at 12.37. So we're bullish of this medium term, and we're just looking for the right entry points. I did a medium-term report for Saxo last week, highlighting an entry point around about 11.92, and we've been looking to get in, and we've been looking for this to target, initially target just below 1300, this area back in early 2015, onto 1400, and then 1500. So it's quite clearly a nice reversal. We've had a real big pullback on Friday. Sorry, a small pullback Friday, but a real big pullback today. You can see this like this indecisive day contained in the top half of the previous day's rally, and then a clear reversal has kicked in. But we're looking to set longs just around about this area where there was this congestion. So looking to get along around about 11.90. Stop would be a break of 1100. But again, you're looking for targets of 13, 14, and 1500. So we are bullish of gold on a medium-term perspective. If we are to see a close and sustained period below this trend line or below this 1200 area, then over time that would change our view. But our initial outlook is to get the right risk reward areas to buy into this temporary dip. So I've covered oil and gold, the two major ones. Is there any other markets that people would like me to have a look at? I'll have a quick look at silver. No one seems to be mentioning anything, but silver again highlights a bit of an evening star formation, not a perfect one by any means. Nevertheless, it's a negative day today, and basically that's sort of like we're slightly bearish on a daily basis, daily intraday basis. But from a medium-term perspective, you can see that there's a similar formation going on in silver. It hasn't quite closed above that ending wedge formation pattern, so that hasn't quite triggered. So silver is slightly different to gold. Gold definitely is the leader, but yeah, that's we would be standing aside on silver at the moment, and this week will be very interesting and give us the close at the end of this week will be pivotal. If we close below last week's open, or even close below last week's low, then that would be a clear reversal and probably set the path downwards again for silver. But I think there's plenty of volatility in this week's market to keep everyone on their toes. Copper's reacted higher at the moment. That's bounced off the $200 level, and although we've seen an extended move to 208.50, we had resistance around 208.50, but we're looking to buy dips in this morning. But from a medium-term perspective, again, that looks to be setting up an inverted head and shoulders. We'll keep our eye out on that, where we've had the sell-off, and we've seen the shoulder, the neckline, the head, the neckline, the shoulder, and see what happens when prices get back up to this second resistance on one of our major resistances around about $213 in that. A break and close above there, clear break of maybe this 215 area, clear break above there, and that would coincide with maybe a stock market rally, a move up to 232. But at the moment we expect this to fail. We expect to be looking to sell into this area of 213 to 215. The more positive thing about this move recently in February is the higher low, which was around about 200. So that's quite significant. So that paints a slightly more positive scenario for copper. But nevertheless, we're pretty bearish overall until we see a break. I'll quickly jump into platinum, another precious metal, and similar sort of price action to gold and silver. Look at the daily chart, and we can see the same thing. 7 decent positive days and a couple of negative days. Momentum still looks to be strong, and we can see that trendline support will be coming in just above the 900 level. So we'll be looking to buy into dips, but on a daily basis, our daily signals will be selling this, looking for lower levels, but expecting it to be limited. So I've pretty much covered the commodities and equities. Again, if there's any other markets that people would like me to quickly scan and quickly give a trade idea, medium-term outlook on, then I'm quite happy to do that. But if not, we can wrap up a little bit early there. All your feedback is very much appreciated, and as I say, if there's no other markets you want to look at, then we'll call it a day. No problem at all, Pan. Thanks for the feedback. Any feedback, again, greatly appreciated. But I'll be on again in a couple of weeks' time. Next week at the same time, 12 o'clock, Ian Coleman will be presenting foreign exchange medium-term outlook, and you can find us over at PIA. We have a subscription service. We also have a free subscription service which gives a daily free call. Feel free to come over to there and have a look at our site and see our flagship product, the daily predictive analysis. This will be on video, John. So take a look at it. It should be ready very soon after we finish. So I'll give you the a full rundown of that. Many thanks for all your time. The video will be available on FX Street. I think Adinda would be able to post a link. If not, I'll find the link and I'll post it in this chat so you can have a look. Thanks all for your time, and look forward to speaking to you all again soon.